On Monday, April 27, 2026, U.S. markets hit record highs, with the S&P 500 closing at $7,173.91 and the Nasdaq at $24,887.10. While the headlines look calm, the setup is tense. A cluster of mega-cap tech earnings is coming, and AI CapEx guidance will likely influence how much risk investors keep in the biggest index names. Wednesday, April 29th, is the pressure point for the market. Alphabet, Amazon, Microsoft, and Meta all report after the close, followed by Apple on Thursday. These are not typical corporate updates. These firms sit at the center of the index: AI infrastructure, cloud spending, and advertising demand. The defining question this week isn't just whether they beat earnings estimates. It's whether their forward guidance can defend the high valuations currently priced into mega-cap leadership. Investors are operating in a market where the performance hurdle is already very high. As of April 24, with 28% of the S&P 500 having reported, 84% have topped earnings estimates. The blended earnings growth rate currently stands at 15.1%, while valuations, measured by forward PE, are hovering above their 5- and 10-year averages. This creates a strong backdrop, but one that leaves very little room for error. When expectations are priced this high, the market quickly loses patience with ambiguity. Monday's tape illustrates the current tension. The S&P 500 and Nasdaq set new records, while the Dow slipped. This mix shows the index can climb even when market participation is uneven. But it also highlights the need to look past headline strength. When a market is held up by concentrated leadership, it often looks steady right until those same leaders stop absorbing the pressure. Capital expenditure guidance has become the hinge for this earnings week. As major platforms report, the market is weighing two distinct outcomes. One path sees cloud demand, ad growth, and AI product adoption rising fast enough to validate the current infrastructure build-out. The other, tougher possibility is that spending continues to climb while the financial payoff remains difficult to quantify, keeping cash flow under pressure. Investors should approach AI-framed layoffs with nuance. While companies often present job cuts as a way to prioritize efficiency, these restructuring efforts are not automatically bullish. The market needs to see if these moves reflect genuine automation leverage and margin expansion, or if they are simply standard cost control measures receiving a fresh layer of branding. For this week's earnings reports, the signal investors are watching for is not the slogan, but tangible evidence in margins, forward guidance, and actual demand. The semiconductor read-through remains powerful. TSMC guided second quarter revenue between $39 billion and $40.2 billion, projecting full-year revenue growth above 30% in US dollar terms on the back of AI and high-performance computing demand. That confirms strong demand for AI infrastructure, but it also raises the performance hurdle for the large platforms purchasing that capacity. Investors are now watching to see which of those companies can effectively turn these chips into tangible returns. Microsoft and OpenAI are evolving their partnership. While Microsoft remains the primary cloud partner, their updated agreement is non-exclusive, allowing OpenAI to deploy products across other cloud providers as well. This isn't a breakup, it is a shift toward a more open commercialization model. For investors, the takeaway is that AI distribution is broadening, meaning the market is increasingly focused on execution over simple partnership scarcity. Alphabet is a useful single-name lens for this week's earnings cluster. Its report spans the full breadth of its business, from core search advertising and cloud demand to its custom AI chips and model distribution. More than just an earnings per share number, the focus is on whether a full-stack AI platform can translate such heavy, multi-layered investment into durable growth. POET Technologies serves as a stark case study in the risks of customer concentration. After acquiring Celestial AI, Marvell canceled all associated purchase orders, including initial production units that had been on the books since 2023. While POET noted a separate, roughly $5 million order with another customer, the event highlights how quickly AI supplier momentum can shift. It is a blunt lesson for the market. In speculative tech growth plays, customer concentration and contract risks can often move much faster than the underlying innovation. Record equity highs don't erase underlying macro risks. Bank of England Deputy Governor Sarah Breeden recently warned that current asset prices may not fully account for these challenges. While crude prices have risen and shipping through the Strait of Hormuz remains effectively stalled, these geopolitical and energy factors are not the primary driver of equity trading today. Instead, they serve as a necessary reminder that today's market peaks are resting on a backdrop of energy, rate, and confidence sensitivities. To navigate this earnings week, keep your watch list narrow and practical. First, look for whether Wednesday's reports support higher AI capital expenditures without damaging investor confidence in margins. Second, watch for signs of improving market breadth, or if index gains continue to rely on the same small group of leaders. Third, monitor whether profit-taking remains controlled after such a strong April rebound. The goal is not to predict the outcome, but to recognize the signals that would shift the risk tone quickly. April 27 gave us a strong, albeit demanding, market tape. While records are still being set and earnings continue to beat, the AI infrastructure cycle now faces a high bar. The test from here is straightforward. If upcoming guidance confirms both solid cloud demand and disciplined capital spending, the current rally has the fuel to continue. However, if that guidance sounds expensive without showing a clear payoff, that concentrated leadership could quickly turn from the market's greatest strength into its main vulnerability.